Welcome to Subramani. Please hit the bell icon. Please subscribe. I was looking for topics and I found this very interesting question. Why is equity investing considered to be for the real long term, like say 30 years, and not short term, like 3 weeks? It's a very good question because many people uh, you hear many people saying that equity is for the long run, equity is not for the short run. First of all, I don't agree with that statement also. I think equity is forever, like what Warren Buffett says. So you bought a share in 1979 and you are still holding on, which means you're holding it on for 45 years. Now it will not matter at what price you sell, because you bought it at whatever price you bought it at. Maybe you bought it at 50 rupees and then it gave bonuses, etc. So today your cost is 20 paise or 30 paise for that share, so it doesn't really matter. And whatever price you sell it at, so very clearly the holding period should be undefined, infinite. So if you say that I bought the share today and I want to sell it after 3 months, you're saying I will be able to predict what will be the price after 3 months. That's not true. That's not true for individuals. That's not true for fund managers. So if a fund manager buys one share at 70 rupees and the company grows very well and it reaches a price of say 1700 rupees, at what stage should he have sold? Should he have sold at 140 saying, oh, my money has doubled? Should he have sold it at 700 saying I already have a 10 bagger, it can't be a 10 bagger again, so what should I do? So these are questions which are very difficult to answer. So largely you should not have a sell by date, because you do not know on that date where the market will be. So if you are trying to save money for your daughter's education, so you should not say, oh, my daughter's education is 5 years away, so I'll put money in equity and on that day I will be able to sell. You may not be, the market may be down. So largely because we are unable to predict how the market will go, or at the particular single share price, at least I'm not talking of the index, can do such things, right? Can be very wavy. I have seen Lupin Laboratories grow from 70 to 700 to 70, right? So all these things have happened. So at what stage should you sell, that you don't know? And that means there is definitely short-term volatility and unpredictability. You bought some share, then suddenly that whole industry goes down, or you bought some share and that company had a factory in Bangladesh, the Bangladesh factory got shut down, it has a factory in Pakistan, factory got shut down. Any of these things are capable, right? Anything can happen. Or it's in a bad state where the government is not cooperative at all, so it's not doing well. So these could be the reasons why in the short run you could have a problem. In the long run, they may just shift the factory out of that location. So in the short run, that you will have volatility and you will have unpredictability. Perfectly possible that in the short run the market booms and you do very well over a 2 year period also. But the assumption is maybe it could do well, maybe you could run out of patience. You bought a share for 70 rupees, you thought it is a good buy, it went to 140 rupees, you sold it off because you said, oh my god, it is doubled. So after that it's become a 20 bagger. Then what do? How long do you wait, right? So you don't know. So you buy and hold and then you see whether it should be sold. Maybe you have 5,000 shares of Bharti Airtel. And then at what stage do you start selling? You bought it at 80 rupees. Then there was a bonus, there was a split, and now the share price is 2,000 rupees. At what price do you sell? Or do you just say, oh, it's permanently got to be there in my portfolio, like I have Colgate, a Pfizer, a HUL. So I will keep Airtel permanently. I'll keep Zomato permanently. No clue which of these shares should be permanently there, which of these shares should be sold and bought back. We don't know. So hence we say we don't want to take the risk of short-term volatility and unpredictability. Again, you held it for 30 years and you say, oh, I've held it for 30 years. Subra said 30 years is what you should hold. And today I'll sell. Maybe that day the market is bad. So maybe you'll sell it in 3 years. Maybe you'll sell it in 45 years. Maybe you'll not sell it at all and your children will continue to get the dividend of that share. So any of these things should happen. So you should largely, when you have equity, you should not have a end date. And this is what direct equity. I'm not talking about equity mutual funds. Equity mutual funds, if you're happy with the return, you were expecting 14%, you've got 24% for 3 years. You say, okay, my 25 lakhs has become 50 lakhs, so my 25 lakh SIP is worth now 50 lakhs, so I will sell a portion of it. That's perfectly all right. Stock prices can swing wildly in the short term due to factors like market sentiment, news events, economic reports, change of prime minister, right? Any of these things can happen. Geopolitical tensions, or even just social media hype saying, oh, this industry is not doing well, and the market hammers it down, or the market talks it up. For example, a single earning miss, or a bad tweet from a CEO, or a CEO quitting, or CFO resignation, or an auditor's qualification. Any of these things could have dramatic impact on the share price in the short run, whereas in the long run it would just take all that in its strides. Over 2 weeks, it is really impossible to consistently predict any of these movements, right? Or 2 weeks or 3 weeks. So this makes short-term equity trading more akin to speculation or gambling rather than pure investing. And even professional traders don't do very well, though I have some fantastically brilliant professional traders who make money in the short run and in the long run. In contrast, this over decades, these short-term fluctuations tend to get ignored and smoothen out. They'll say, oh yeah, this market, this earnings has been missed, but doesn't matter, next quarter earnings will be good, and it might turn out to be true. The second is the power of compounding, especially if you have money in equity mutual funds. Here I'm not talking of direct equity, because in direct equity, when the dividend comes, you may not reinvest it with tremendous discipline, and you may have to pay 30% tax on that, right? Because the dividend income is fully taxed. Now if you have a growth option in a good, let's say, a flexi cap fund, right? It's a equity fund, and you leave it there for 30 years. The power of compounding kicks in. All the dividends, nothing you have received, because the mutual fund house receives the dividend, and you're just seeing all that getting reflected in your NAV. So over a long period of time, say 30 years, and with a good fund manager, you will have a super multi-bagger. Your 10 rupees would have become 1,000 rupees kind of thing, and you're wondering what happened, how did it go up 100 times? Simply because you put more and more money, and the NAV has also gone up. So you have more number of units at a higher NAV, so obviously you have done very well. So the power of compounding set in. The long-term investing returns to largely being compounding, where earnings generate more earnings. So if you invested, let's say, 10,000 rupees in a diversified portfolio managing 7 to 10% annual returns, historically true for in many countries. In India, it would be 15-16%. It could grow to over 1 lakh in 30 years through reinvested dividends and capital appreciation, right? So plus, if you didn't put in any money, I'm just talking of one time, right? In 2 weeks, this compounding is negligible, right? 2 or 3 weeks, it is negligible. There's no earning, so nothing can compound. So to compound, you have to create moss, right? Rolling stone gathers no moss. If you have to collect moss, you have to stay in one place. Then this also helps in risk reduction. Let's say you bought a share, and in Nepal there is an uprising, and the market falls 20% or 30%, or Trump announces a tariff and the market falls. Let's say TCS, Infosys and HCL, which were there in your portfolio, have all fallen, say 30%. But come Jan 2029, there will be no Trump. Some of these tariffs could be withdrawn. Some of these things would happen. I have no clue what is going to happen in Jan 2029. So in the longer run, the risk reduction through time diversification, right? So the timing risk is reduced. You bought, and then next day Trump announced the tariffs and the markets crash. You can't do a thing about it, right? So a 2 week horizon means you would now have to get out, because you don't have money. You may have a leverage position, or you may need the money after 2 weeks for something else, so you will be forced to sell. Whereas investing is about investing the surplus that you have over a long period of time, so that when you sell at a much higher price than the price at which you bought, and you have got good real returns. For all this to happen, there has to be time, there has to be compounding, there has to be reduction of risk because of longer time period. For example, holding stocks for 1 year, there's a 25 to 30% chance of negative returns. For 10 years, it drops to about 5 to 6%, right? And for 20-30 years, it is very close to 0%. Though, of course, I have to add that the past performance is not an indicative of future performance, but the chances are at least it will rhyme. So for a 30-year period, I dare say, if you have money in a multi-asset fund fund or even in a flexi cap fund, chances are if you do an SIP, there is no way how you can get a return which is not real, right? Which is less than inflation and taxation adjusted, right? So also in the longer run, you tend to focus on fundamentals versus noise. You tend to look at is the management quality good? Are they adding value to themselves? Are they adding value to the shareholder? Are they adding value to the customers? Are customers coming back to them? These are all indicators which you can see only in the long run. So basically, you can focus on fundamentals versus the noise of saying, oh, they got a new MD who talks very well and things like that, right? So and in the long term, the long term investing, you align with fundamental growth. You can see how much they are growing. So if you take an Infosys or a TCS or a HDFC Bank, you are going to see that over a long period of time, the PE and the market price tracks the EPS, right? So when the EPS growth is good and predictable, the company gets a higher PE, right? So all those things happen, and all those things you can see only over a long period of time. Also in the short run, you have costs and taxes which are very hurtful. So you will have GST, you will have STT, you will have capital gains tax, right, and the brokerage. So all these things, costs and taxes, will eat into your short-term gains. In fact, I do think in the short term, the biggest gainer is the state and not really the investor or even the broker. This does not this brings me to another thing. This does not mean equity trading can't be done. It requires a much higher level of skill than what, say, I have. So I would rather be an investor than be a trader. I could be a trader in a small portion of my portfolio where I'm doing it more like fun and hobby rather than like profession. If you're doing trading as a profession, you need a lot of tools, you need understanding, you need analysis, right? Only then you can do it. So don't dismiss trading as, oh, trading is not for me. No, trading is really not for me because I don't have the ability to trade. I'd rather be a safe investor rather than be a trader. I don't have the trading skills. So you have to understand all these things before you decide whether you want to be a trader or an investor. So like going back to the question, is the equity market for 2 weeks, 3 weeks? Answer is no. Equity market is more like for 2 years, 20 years, 30 years, 100 years, and infinite, right? Like Buffett says, let me repeat, forever. Forever is what you hold equity. You may sell it in between, that's a different thing, but you largely buy it holding it forever. Thank you.